Hello, channel members. I hope you guys are doing really well. First of all, I want to say thank you so much for the 57 channel members that we have. I really do appreciate all of your contributions. First of all, it feels great for me. Second of all, it buys me a cup of coffee. And third of all, it supports my business of YouTube, my side hustle that I'm trying to, make into a bigger business. In any case, thank you very much. I want to be a content creator that first of all gives you value. So I want to make sure that each and every one of you guys makes your $3 back. A lot of people have been asking me questions, especially the new people in the channel membership, which is great. And I want to give you guys a video specifically answering those questions. If you have any questions, it's very important to ask me, and I'll be able to make you another follow-up video because I don't know who knows what, so on and so forth. In this video, I'm going to be covering options. I'm going to explain to you what an options is. I'm going to explain to you what a call option is. I'm going to explain to you what selling covered call options play is. I'm going to explain to you what a options spread is, aka the play that Ahmed did with Robinhood. These are questions that people have been asking me in the comments. I'm going to explain to you how to use an options calculator to foresee how much your options are going to be worth in the future. I'm going to explain to you what theta decay is, and then I'm going to explain to you implied volatility and whether it's better to buy or sell options with higher or lower implied volatility. I even made myself a notepad to make sure that I don't miss anything. Again, I'm going to do a lot of talking. This is going to be very long, and I'm going to do a monkey see, monkey do, as I got in my comments, and I'm going to give you guys examples using Robinhood. Before we go any further, what exactly is an option? An option is a contract where you're saying, in the future, I will either buy stocks from you or I will sell stocks from you. That's all it is. It's a contract between me and you. However, you never meet the person that you're buying or selling to, and the person buying or selling never meets you. To make it very, very simple, that's an option. Then you have call options, and then you have put options. Put options in general, you're betting that the price of the shares of stock are going to go down. I will not be covering it in this video. Call options means that you're in general betting that the price of a certain stock is going to go up in the future. When you're doing call options, you are paying a premium to somebody to buy shares of that stock in the future at a certain price. When you are selling call options, you are collecting a premium from somebody that is saying, hey, I will pay you money for a contract that if the price of a certain stock hits a certain price, which we call strike price, you will sell me those shares of stock. I'm now going to go into an example showing you call options and a covered call and how they exactly work. After that, I'm going to explain to you what a spread is. I'm going to explain to you intrinsic, extrinsic value of options. I'm going to explain to you theta decay, and I will also be explaining to you the correlation between theta and as you get closer to your strike price or you get closer to your expiration date. If this sounds Chinese, just relax and watch the video. I'm going to make it super simple for you. This is my Robinhood account. If you guys need a link to Robinhood, I will leave a link to Robinhood in the comments section down below. If you sign up, you get free stocks, I get free stocks. I would appreciate it, but you can do the options trading through any options platform that you'd like. I find that Robinhood is by far the easiest. Let's use a very familiar stock to most people on this channel, PLTR, which is Palantir. In order to trade options, you got to go right here to trade options. If you're using a mobile, you'll see it. It's the same place on the bottom right. I want you to click on trade options. When you click on this, you're going to see buy, you're going to see sell, you're going to see call, and you're going to see put. This is what I was saying before. Also, on the right-hand side, you're going to see an expiration. The expirations are going to be when the expiration of the contract is, which I'll explain to you in just a moment. Right now, the expiration is already into June 2025. You even have expirations December 2025. Whenever you buy an option that has a longer than 1 year, it's considered a leap option or long option. Anything less than a year is considered short options. It's just the time duration of the specific option. Now, let me show you first how to do things. I'm going to do buy, and I'm going to press call. You're always going to see the share price here when you're using Robinhood. It is a really, really good user interface. These are all my different call options. Let's say I want to do a call option. Let's just make it very, very simple. I'm going to do January 2024, right? My share price is $18. Let's say I believe that in 1 year from now, the price of Palantir is going to be, say, $25. Now, you're going to have something right here that says 178. If you click on 178, and then you're going to press continue, you're going to see that you have contracts right here. $1.78 is per share. Every single options contract is 100 shares. So in order to calculate how much an option is going to cost you, you're going to take this price, 178, and you essentially times it by 100. 178 for one share. One contract is 100 shares. 100 times 178 is $178, which means to buy one option of Palantir that will expire on January 19th, 2024, at a strike price of $25, it will cost you $178. Now let's explain exactly what that means. The strike price is the price at which you are allowed to buy the shares if the price of Palantir hits $25. If the price of Palantir does not hit $25, you cannot exercise the option. Exercising the option is buying the actual shares. However, you can sell this option to somebody else at any point in time as long as there's liquidity and someone's buying. Options like trading the SPY, trading the NASDAQ, trading Tesla, trading Apple, trading Palantir, all these type of stocks, there's usually liquidity. I've never seen there not be liquidity. Trading stocks like HIMS or Truist Financial, things like that, those boring stocks, there's not a lot of liquidity, and sometimes you can't even get short-term contracts. But that's a different story. So when you're buying options, it's good to know the liquidity if you're going to be able to easily sell out of your options if you needed to. Okay, so let's do one other example. Let's say that you think that Palantir will be $30 instead of $25. So instead of doing $25 strike price, which cost you $178, let's do a different option. Let's say instead of you thinking the price is going to be $25, let's say you think the price is going to be $30. Well, all of a sudden, instead of paying $178 per share, you're now paying $113 per share, which means you're paying 100 shares, because one contract is 100 shares, times $1.13. It will cost you $113. Why is this cheaper than this one at 25 because it is harder to get to $30, which means you pay a cheaper price because the probability of Palantir hitting $30 as opposed to $25 is logically lower when you're buying this option. So that option is going to be cheaper. The closer your option is to the money, what exactly is to the money? The actual share price today, the more expensive that option is going to be. Matter of fact, if you buy an option that has a strike price lower than at the money, so at the money is 1804, lower would be 18 or 17 or 16, you are actually starting to pay significantly higher. Why? Most likely in a year from now, the price of Palantir is going to be higher than the current price of Palantir today. In general, theoretically, logically, that is the way it actually works. Now let me show you the opposite of buying, and I want to do a sell. So I want to now sell my options. When you sell an option, you are the opposite of buying an option. When somebody is buying an option, you're buying it from somebody that's selling you that option, okay? Buying means you are buying the rights to buy shares at a later date. Selling an option means that you are giving somebody the right to buy your shares at a later date. When you are selling options, you need to have a minimum of 100 shares because each contract is 100 shares. For example, if I am selling a $19 strike, it is $3.40 premium. This is the amount of money I will be getting per share. So let's say you are going to click, I want to sell. So now you're going to click continue, $19. So now you're going to say 100 shares, which is one contract at $3.40, you would collect $340. This is your profit. You are saying that if in the future the price of Palantir hits $19 before January 19th, 2024, you will sell somebody your 100 shares for $19. Now, what is the negative about this? If Palantir hits $30, you are still selling your shares for $19. That is the only downfall. But there are a lot of insurances when it comes to that. For example, if you have enough money, you can purchase the shares and then sell them the purchase shares instead of the shares that you actually have. I personally love this strategy because I collect money every single week. Except my strategy is a little different. I never, ever sell my call options unless they're the same week. So usually I will sell a call option on either Monday or Tuesday of the same week, and I usually sell it 20% out of the money. So if the price of Palantir is $18 right now, I would be selling 18 times 1.2, which is 20 cents, which is 20%, $21.60. So I would be selling this option right here, either a $20.50 or $21 option. Look, if I was to sell a $21 option, I would be getting 57 cents per share. If you do the math over here, that means I would be collecting $57 for every 100 shares of Palantir that I own. This is absolutely massive. It's absolutely huge. And the reason this is happening is because of the implied volatility. Whenever you have high implied volatility, that means you should be a seller of call options because you are going to be collecting a shit ton of premium. Whenever there is low implied volatility, you would like to be buying call options because you're getting a really good deal in theory. Usually, when I sell 1 week, 20% out of the money, I am only collecting about 2 cents per share. So instead of getting $57 for my contract, for my option, I am only collecting $2. You heard that correctly. Now, this 57 cents or $57 for contract obviously is inflated because it's the weekend. On Monday, this should actually go down. However, because we have earnings, that's why the implied volatility is so high. I would wait until after earnings. So if you're playing options, I would not sell call options until Tuesday because I want to see what's happening after earnings. So far, I never got called on my options. The worst thing that's going to happen on your selling call options, if you get called on them, you have to sell them for the strike price. So if you're making 20% on top, would you really be unhappy for selling? I mean, if you're selling call options, you got to be comfortable with your play. You have to be comfortable with your position. You have to be able to tell yourself, I don't mind making a certain amount of money. And if I made that certain amount of money, sell a V, I'm not going to be mad. When you're selling call options, you can sell call options from a regular account or you can sell them from a tax preferred account. In a regular account, selling short options or call options, you are going to be paying short-term capital gains, which sucks. That's your personal tax bracket. If you are selling from a tax-deferred account, well, the tax is deferred depending on what account you have, whether it's a SEP IRA, Roth IRA, a regular IRA, an HSA, which is a health savings account, so on and so forth. We can go over taxes in a different video if you guys want. I'll be happy to explain it to you. Very, very important. In the comments down below, you must explain to me if you understand what I'm saying or not. Let me show you what I mean. This is Palantir. You're not going to see it, but if I go down to my history right here, these are my contracts. So this is a contract that I sold last week. The volatility was very high, the implied volatility, and because the implied volatility was very high, I collected 4 cents per share. I sold 120 contracts, which is 12,000 shares. 12,000 times 4 cents gives me $480. This $480 I collect as a premium right away. I said that I will sell a covered call option for 4 cents per share, which came out to $480 until August 4th, which is that last Friday. And I said that if Palantir hits $25.05, $25.50, I will sell 12,000 shares of Palantir for $25.50. If I was going to get $25.50, I would not cry about selling my Palantir going into earnings. However, I have a lot of buying power. You see right here, I have buying power of $321,480.79, which means if I needed to scoop up 12,000 shares of Palantir, I would be able to afford 12,000 shares of Palantir for $321. So I would just buy the shares, I would sell the shares that I bought, and I would never have to actually sell the shares in my account. So I would never actually have to pay taxes on that, give or take more or less. Now, if you go a little bit lower, the week prior, I sold covered call options for $20 strike, expiration 7/28, which is the previous Friday, but I only got 2 cent premium. You see, this is normally what I'm getting, 2 cents. And again, this was 20% out of the money. The week before that, I was getting 3 cents a contract. So I sold for $360 and I had a strike price of $20. Now check this out. In 3 weeks, I made $480, I made $240, and I made $360. That's $1,080 selling covered calls. This is not my only account. This is just for this account. It's quite lucrative if you look at it. Now I want to explain to you another strategy. Somebody asked me in the comments, Adam, what is a option spread? An option spread is quite simple. You buy an option at a lower strike and you sell an option at a higher strike. So you're buying a call at a lower strike, you're selling a call, covered call, at a higher price, which means, let's say you're buying X stock and you're saying, I'm buying a call option with a $100 strike. You're also selling a covered call at a $120 strike, for example. You're collecting the premium for the covered call. You only have to sell the covered call if your strike price hits for your call that you bought. So you're making money on the premium, which allows you to allocate that on the call, and you only have to sell shares if your original call comes into play. So you're buying X at for $100 strike, which I'll show you an example in just a moment. If X stock hits $100, you buy X stock at $100, and you're selling X stock at $120, which is a call option sell that you did. You're selling a covered call. Let me give you an example. I'm back in Palantir. I'm going to do trade Palantir options. All right, let's go to expiration date. Let's do January 19th, 2024. So I'm going to buy an option. Let's say I think that Palantir is going to hit $30. So I'm going to buy this option right here at $1.13. If you click on this, it's going to cost me $113, okay? That's what this option is going to cost me. Now, instead of buying, I'm also now going to sell. So then I'm going to press sell. But instead of selling at $30, I'm going to sell, let's say, at $35. I hope everything that I'm explaining is making sense. Again, this is made for you guys to ask questions. Now I'm going to explain to you one variable. There's something called Greeks. And Greeks are the relations of your options. I'm going to concentrate on the most important Greek, in my opinion, called theta. When you're buying an option, you have two values, intrinsic and extrinsic. Intrinsic value is the value that's constant and it's in relation to the price. Extrinsic value is a value that is not constant and it's the relationship of your options to your time. And theta is the decay. When you're buying a long-term option, you're okay. In general, theta decay is highest at the money. When you're in the money, so for example, let's say you're buying an option for, actually, let me show you guys. Right here. Let's say right now you're going to buy this option for January 2025. And in January 2025, you're saying that the price of Palantir is going to be $35. If you click on this, and you go a little bit lower, these are going to be the Greeks over here. Right here, you have theta, okay? You have theta of 0.0059. Now, this option is $2.62, which means every single day from this $2.62 option, you would be losing 0.0059, okay? So let's make it very simple. $2.62 minus 0.0059. So the option that you bought today for $2.62 is going to be worth less tomorrow. What's the less? $2.6141. It's very important you understand what theta is and how it works, but I'm going to give you a quick cheat sheet that serves you very, very well. When you're buying options, right, and you have a strike price, you can buy the shares of stock. But a lot of times you can sell the option to somebody else, right? I was talking about this in the beginning of the video. When you're selling that option to somebody else out of the money, there's still value. What is the value? The extrinsic value of that option. Or leaps, right? When you're talking about a year or longer, the theta decay is not going to be that crazy. Essentially, the last 3 months of your options is when you're going to have crazy theta decay. So when you're 3 months to expiration, that's really when you have to keep track on it. This is a rule of thumb. Then 2 months out of the expiration date, it really starts taking into effect. And the last 30 days of your options, the theta decay absolutely destroys you. When your options, right, the actual price of the shares is at the money or below the money, out of the money, This is when theta decay really F's you up. If the strike price is lower than the share price, there is no theta decay. What does that mean? If you're buying an option, let's go like this. Let me show you. Let's say you're buying this option right here. Palantir, $35 strike price, January 17th, 2025. If, let's say, October 2024, the price of Palantir is actually $36. Theta decay slows down like crazy and comes to a halt. Why? Because the strike price is below the actual price. So if the share price is going to be above the strike price, you don't really have to worry about theta decay. However, if the share price is the same as the strike price, there's going to be a hell of a theta decay, especially as you come closer to the expiration date. Specifically, the last 3 months is going to absolutely destroy you. Or if you're out of the money. So let's say the share price is $33 and the strike price is $35. Theta decay is going to kick your ass big time. Most people, when they're trading options, are not going to pay attention to theta decay because it's something that most people don't understand. And to be fair, most of the options that you're going to play are going to be long-term options. If you're doing leaps, don't even worry about it. If you're doing short-term options like a month, you're going to get absolutely destroyed, shellacked, or 2 months or 3 months. So a lot of people that are playing options for earnings, if you don't actually hit your options play and you have like a week or 2 weeks after earnings, you're going to get absolutely destroyed, shellacked. If you're playing same-day options, you don't really have to worry about theta decay because it's not going to destroy you. It's super confusing, guys, and if you guys have any questions, let me know. This video is like 40 minutes long before I edit it. I think I explained this as simple as possible, and I explained a lot of the questions that people are asking me. Let me show you one last thing, okay? That's very, very important. Let's go to PayPal, because a lot of people are asking me about PayPal. So I got PayPal, and if you go to play options, I have an expiration of January 2025. This is a leap. And I have a lot of these options right here, 145 strike. I have 81 of these options in this specific account. So if you want to buy this today, it would cost you $1.56 per share times 100. Well, that would end up costing you $156. If you click on this, as you can see, the theta is extremely, extremely small. It's 0.0070. You have a lot of time. Look, when you're trading options, it's not one-to-one. So if the price of a stock goes up 5%, it doesn't mean the options is going to go up 5% or down 5%. It's not one-to-one equivalent. You need to be able to figure out how much that option is going to appreciate in the future. So a lot of people are asking me, Adam, is it still a good time to buy PayPal? Now, PayPal's value went down. The day that PayPal was down 12%, I made videos about it. This change in value went down like 40-something%. So anybody buying these options right now is buying them literally at the same price as I was buying them. Some price I bought was better, some price I bought was worse because I averaged in. But at one point I was up like 300% on this. Right now in this specific chain, I'll show you in a moment if I'm up or down. I honestly don't even remember, but it's somewhere around even. But let me show you something called an options calculator. This is a really cool options calculator. Jesse Dow actually gave me this. I like it a lot. So all you got to do is put in the stock symbol, PayPal. Press get price, and they're going to give you the price, $62.79. The current price is $62.79. Sorry about that. So the whole question is, Adam, if I buy PayPal at a 145 strike, January 17th, 2025, what does that mean? That means you're going to be paying $156 for one option, which is 100 shares, to buy PayPal at $145 if PayPal hits $145. You can also sell PayPal at any point up until the expiration date. As long as there's liquidity, you could sell the option to somebody else in the future. Remember, you can either exercise the option, which is buy the shares, which most people don't do, especially options traders, or you can sell this option to somebody else at a later date. This option will significantly become more valuable if the share price actually crosses the strike price, significantly higher if you want to sell it. Now you're going to say, but Adam, look, the share price is $62 right now. What happens if the price goes up double? Let's say the price is going to be $125. Am I going to make 50% on this option, or, what's the deal? What's going on? So let's do the actual math, okay? Right now it's $62.79. I want to do an options chain, January 17th, 2025, 145 strike, and I'm going to do the mid, which is 156. One option will cost me $156. Let me just make this a little bigger for you guys. There you go. That's easier to see. Press I agree. Over here, they're going to ask you, can you please put in a range? So I am going to say that I believe PayPal should be worth $100 and to $150. So let's say the range of PayPal for January 17th, 2025, you're saying it's going to be between $100 and $150. Let's calculate what this option can possibly be worth. You're going to have this very interesting chart right here. On the left-hand side is going to be the price of PayPal, 150, 148, 147, 157, so on and so forth. Right here, you're going to have a bunch of dates up until the expiration, which is January 2025. On the right-hand side is going to be the percentages of the price going up. Since we're not going to wait past 3 months before expiration, let's go away 3 months. December, November, October. Let's give ourselves September and August just for good measure. So let's say that we're going to hold this option for July 22nd. Let's say that in July 22nd, the price of PayPal actually hits $100. If the price of PayPal hits $100, you would make 55.8%. Okay? But check this out. The current price of PayPal is $62, but it goes up to $100. 60 to 100, it goes up 60%, so you would make approximately the same amount as if you held the shares. However, let's go to 125. Let's say that the price of PayPal on July 22nd hits $126. You would not double your shares. You wouldn't double, but you would actually end up making 572%. So while most people are making 100% if you're buying the shares, you would be making 5.7x. If it hits 124.50, you would make 533%. Let's say PayPal only hits $120. If it hits $120, you would still be making 420%. As a matter of fact, as long as PayPal hits $102, you would double up your money. Most people are doubling up their money when the shares are going to go to $125. All you have to do is get the shares to $102. If by some miracle PayPal by July 22nd hits $150, you would actually be making 1,323% on your money, or 13x on your money. The options calculator is not 100%. As Jesse Dow likes to say, this is something you use as a guide, not, the be it end all. It's late. It's like 10 o'clock at night. I was chilling with my family all day. I really wanted to make this video for you guys, so I don't know if I'm going to edit it tonight or tomorrow, but I wanted to get you this before the weekend. If you have questions, ask me. But I want to show you one thing. I'm sorry, I just noticed this. But check this out. This is the theta right here. Do you see how this is green, 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 green? As you're getting to that expiration, remember how I said 3 months? January, December, November. Right around October, all of a sudden you start seeing red. Why? The value of your options, the extrinsic value of your options goes down like a motherfucker the closer you get to your expiration. This is what I was talking about, theta, right? This is exactly what I was talking about, theta. And you could see the crazy numbers, right? Let's say on November 7th, you will be down 42%. On November 3rd, 25th, 3 weeks later, it jumps 70% negative. December 13th, 90% negative, followed by 99% negative. It's absolutely crazy, the rate of theta decay. Now that I said all of that, and this video is almost an hour long, ask me questions. Maybe I didn't explain it right. That's okay. Maybe I don't know something. That's okay. Maybe you have additional above and beyond questions. That's okay. Please ask me down below. None of us are perfect. We have a group. We have a support system. Me, you guys, all together. If this group grows bigger, I'll open up a Discord or a Telegram group, or we'll have more lives. That's the plan. If you have questions, please ask me. I'm not the most experienced with options, but I have a decent amount of options experience. I've learned so much more options following Jesse Dow, and it really made me think and analyze a lot more, so I got a lot better when it comes to the options. Ask questions. Please feel free. I hope we all make money. And somebody asked me, what do I believe the price of PayPal is going to be? What do I think is a fair market value of PayPal? I believe that the price of PayPal should be minimum $100 based on the price of PayPal today is trading where it was back in 2017, except in 2017 for the whole year, the revenue was like 13%. For quarter one and quarter two of this year, our revenue was above $7 billion. So in half a year, we're making more money than we made in an entire year in 2017. And somehow our share price is lower now than it was in 2017. There's many other reasons why I like PayPal. I don't think it's going to be a world beater again. I don't think it's going to be $300 a share like it was at the height. I'm not even sure if it hits 150. To be honest, I don't even give it a flying fizzle if it hits 150. If the price of PayPal hits that 120, 125 mark, I'll be happy. Who wouldn't be happy to make a 5, 6, 7x on their money? If it goes higher, even better. So that's my thoughts on PayPal. I don't think I have anything else to say. Thank you so much, and have a great evening.